Opendoor is staging a dramatic finish to Tuesday's session, running sharply higher into the close after spending most of the day in completely neutral territory. The stock is up more than 5% as we approach the final stretch, and for a company that often moves on narrative as much as fundamentals, the question on everyone's mind right now is simple: what happened? Why did Opendoor suddenly wake up after drifting flat all day? And what does this kind of late session surge actually signal for the sessions ahead? The biggest thing to understand first is that nothing came out from the company today. No filing. No press release. No surprise announcement. No interview. This isn't a situation where Opendoor released something and the market took hours to digest it. The real catalyst behind today's surge is quieter but far more important: a sudden shift in macro conditions that directly benefit companies like Opendoor. When you zoom out, today's move actually makes perfect sense, because Opendoor is one of the purest plays on future borrowing costs, housing liquidity, and risk on rotations. And all three turned in Opendoor's favor this afternoon. The first factor is the Treasury market. Bond yields dropped meaningfully intraday, and that is always a signal that traders jump on. When yields fall, borrowing becomes cheaper in the future. That means mortgage rates are expected to follow. And whenever mortgage rate expectations trend lower, everything tied to the housing transaction cycle becomes more valuable. Opendoor is not just connected to housing, it is hypersensitive to housing liquidity. The entire business model works better when buyers can afford more and when sellers feel confident enough to transact. So when bond yields dropped, the market almost instantly rewarded the companies most leveraged to a future rebound in real estate volume. Opendoor is near the top of that list. The second piece of the puzzle today is rate cut expectations. Several analysts, economists, and macro desks shifted their commentary toward the possibility of earlier or more aggressive easing. Even if those predictions don't come true exactly as stated, the psychological impact is powerful. Rate-sensitive, high-beta stocks often respond immediately because the market trades on expectations long before reality arrives. With Opendoor, even the hint of future rate cuts boosts sentiment. Lower rates mean more transactions. More transactions mean tighter spreads. And tighter spreads mean expanding margins. When you put all that together, Opendoor becomes a leveraged bet on lower rates, and when those expectations rise even slightly, the stock often responds disproportionately. The third macro tailwind today is broader risk-on momentum. As yields fell and traders rotated into growth, companies across tech, fintech, auto retail, and consumer platforms all saw surges. You could see similar late-session strength in companies like Upstart, Redfin, Carvana, and Robinhood. These stocks tend to move together when algorithms detect a shift toward risk-taking behavior. The same flows that lift beaten-down or high-gamma tech names also lift Opendoor, because Opendoor sits at the intersection of real estate, technology, and growth. Anytime those three categories get inflows, Opendoor tends to benefit more aggressively than the average stock. But even with the macro explanation, why did the move come so late in the day? That's where the mechanics of modern trading come in. A lot of today's surge can be attributed to intraday algorithms. Many funds run liquidity models that adjust exposure when yields cross certain thresholds. When the 10-year yield dipped, those models likely flipped into accumulation mode. That creates an upward push. Then retail momentum notices it, creating a second wave. Then short-term traders enter, creating a third. By the final hour of trading, you get what looks like a dramatic spike, even though the underlying driver was building quietly throughout the day. There is also the narrative layer. Even though Opendoor didn't release formal news today, the market is still digesting broader themes from the past week. Kaz's recent comments at the Hope Forum continue circulating on social media. His vision of faster transactions, 3-day closings, and consumer-first flexibility is still energizing the bull case. Combined with ongoing product updates like the Opendoor Guarantee, early move-in expansions, and the refinement of the company's long-term platform strategy, the sentiment surrounding Opendoor has been improving. The macro environment simply provided the spark that allowed that sentiment to translate into price action. There's another angle worth mentioning, and that is Opendoor's relationship with volatility. This is a stock that can spend hours doing nothing, followed by a violent move in one direction. That is because Opendoor trades heavily on flows rather than fundamentals. When the flows shift, Opendoor reacts quickly. While that can frustrate long-term investors, it also means days like today are more significant than they look. Whenever Opendoor breaks from a flat pattern into a strong upward move, It signals that market participants are willing to buy dips or add exposure when conditions improve. That behavior can create follow-through in the sessions ahead. It is also important to understand the psychology of late-session surges. When a stock goes vertical near the close, traders immediately wonder what others might know. That often leads to continued buying the next morning, especially from retail investors who assume news might be coming or that a breakout is underway. Whether or not that is true, the expectation of buying can itself create more buying. And for a stock as liquid and sentiment-driven as Opendoor, those expectations matter. So now the bigger question, what does this mean for Opendoor moving forward? The most important thing is that today's move reinforces the idea that Opendoor remains tied at the hip to rate expectations. When yields go down, Opendoor goes up. When yields go up, Opendoor gets hit. It is almost mechanical. And until the company fully transitions into a more asset-light, fee-based, platform-forward model, that sensitivity will remain. Investors who understand that dynamic can interpret moves like today's more clearly. Another takeaway is that Opendoor's bull case remains alive. A stock doesn't rally like this on a flat day unless there is real buying interest underneath the surface. Today's surge suggests that the market sees Opendoor as a legitimate beneficiary of any stabilization or improvement in the housing cycle. It also shows that traders view Opendoor as one of the highest upside names in the real estate tech space, meaning even small macro improvements can yield outsized moves. The final takeaway is that this kind of move fits the broader narrative of Opendoor 2.0, a company in transition, weathering macro uncertainty, tightening operations, refining its model, and waiting for the right environment to accelerate growth again. When the environment shifts even slightly, Opendoor responds dramatically. Today was a perfect example. So as we head into the close of Tuesday's session, Opendoor's late rally was not random. It wasn't a fluke. It wasn't retail mania. It was a direct response to a set of macro conditions that aligned in Opendoor's favor and activated the algorithms that dominate modern trading. It was a reminder that Opendoor remains one of the market's most sensitive plays on borrowing costs and liquidity. And it was a signal that this stock still has the ability to move very quickly when momentum shifts. The question now is simple. Was today a one-off spike, or the beginning of a new leg higher? That depends entirely on whether yields continue trending lower and whether risk-on sentiment holds. If they do, Opendoor could see continuation. If they don't, today's move might fade. But either way, this late-session surge is a clear example of how tightly Opendoor is tied to the macro environment, and why investors need to watch both the stock and the broader market conditions together.